Good morning, everybody. We seem to have most of the attendees joining online now, so we might get started. So just to introduce myself, my name's Marcus Ohm. I'm the Head of Corporate and Audit Services here at Housekeeping Matters, Judd in Western Australia. So I'd like to welcome you all today to this morning's financial reporting update webinar, which will be presented by Michelle Warren. Now, as you'd probably be aware, from the changes in the invitations, this event was originally scheduled to be held back in early June, with Michelle flying over from Melbourne to present. And unfortunately, COVID got a little bit in the way of that, and Melbourne went into lockdown, which meant that Michelle was unable to fly over to join us in Perth. So we did reschedule the event to this morning, and that was also due to be a networking event in the office. And as everybody on the call who's based in Perth would know, COVID struck for a second time, and Perth's been in lockdown, so we've had to move to the online format today. And I suppose the one thing we've all sort of had to learn, haven't we, during the course of the pandemic, is to be flexible, adapt to new circumstances, often at short notice. So having said that, it's great to be able to welcome Michelle to talk to us today. Now, just a quick introduction. Michelle Warren is HB Manjard's Australasian Director of Financial Reporting. And Michelle's been a very familiar face here in Perth, given a few visits over the past few years to do these sorts of presentations. And I do work closely with Michelle on our National Audit and Accounting Standards Committee, and I can vouch for the fact she's very busy, and she has a very sort of varied role. And a big part of that role is basically developing and delivering training content, thought leadership, running a national technical consultation process, and also providing technical support for audit teams for HLB across the Australasian network. So just a few housekeeping matters before I hand over to Michelle. So the session today will run for 1 hour, and that will include some Q&A time at the end of Michelle's presentation. And in fact, I think there will be an opportunity during the presentation as well. So if you have any questions during the presentation, please type them into the Q&A panel specifically, so we make sure we don't miss those as we go through. And then we'll get to those either sort of during the presentation or towards the end. So without further ado, please let me welcome our special guest this morning, Michelle Warren.
Thank you, Marcus, and welcome to everyone that has tuned in today. So unfortunate that today's financial reporting update has to be virtual, story of my life at the moment. But I guess the upside is you can be in the comfort of your home, in your sweatpants and Uggs, while I get you up to speed on the latest accounting developments. So what will we be chatting about today? Today is very much a financial reporting update. So the aim is to highlight issues that are topical at the moment. Of huge interest in Australia right now is the removal of special purpose financial statements and the introduction of a new Tier 2 reporting framework, which in fact are both effective from today, 1 July 2021. So I'll give you a 20-25 minute overview of these changes specifically and why impacted entities should consider adopting them early. We'll also discuss recent ASIC activity and what ASIC has on its agenda or on its radar for 30 June 2021. I'll spend a few minutes on the new accounting standards that will be effective for the first time in 30 June 2021 reporting periods. You'll be very happy to know not too much happening on that front. While the leases standard is not new this year, leases will change over their lifetime. So I will give you a quick rundown of lease modifications and how these differ to lease reassessments. Finally, we'll close out with a few things that have happened at the international level that you should be aware of, as they could very well impact you. And as Marcus has said, please do feel free to type in any questions in the Q&A box, and I will try my best to answer them as we go along. All right, so let's kick off the session with changes to the Australian financial reporting framework. To set the scene, I thought it best to give you an overview of what is actually changing with effect from today, 1 July 2021. Firstly, our current Tier 2 RDR is being replaced. It's going to be replaced, or it's being replaced by another Tier 2, and that Tier 2 is called Simplified Disclosures. We'll cover off what entities currently preparing RDR accounts will need to do, because these entities already prepare a form of general purpose financial statements. So they are not going to be impacted by the removal of special purpose financial statements. At the same time, so also from today, certain for-profit private sector entities will no longer be able to prepare special purpose financial statements. And I'll explain which entities are going to be captured. I just want to emphasize upfront, it's certain for-profit private sector entities that will be affected. So at this point in time, not-for-profits are not required to move to general purpose financial statements. So if you are a not-for-profit listening today and you prepare special purpose accounts, you can continue to do so. The impact for not-for-profits is limited to those that currently prepare RDR financial statements. So just want to make that clear. All right, so for those entities impacted by the changes, to understand what they need to do, they need to understand what general purpose financial statements will look like going forward. So from today, these are the two types of general purpose frameworks that exist in Australia. We've got our Tier 1 financial statements. These are full-blown IFRS financial statements. They comply with all the international accounting standards, IFRS, allowing our ASX listed entities to make a statement of IFRS compliance in their accounts. Under Tier 1, all the recognition and measurement requirements of the relevant accounting standards must be applied, including consolidation and equity accounting. And in terms of presentation and disclosures, each standard's presentation and disclosure requirements must be followed by Tier 1 entities. So nothing new with respect to Tier 1. Moving over to Tier 2 simplified disclosures, that is replacing RDR. These are also general purpose financial statements. Now, the way that the numbers are derived under simplified disclosures is the same as for Tier 1 and for RDR. So all the recognition and measurement requirements of all the relevant Australian accounting standards must be applied, and that includes consolidating subsidiaries and equity accounting interests in associates and joint ventures. The difference starts coming in with presentation and disclosures. As I've said, to calculate the numbers under Tier 2 simplified disclosures, you'll need to dip into the relevant Australian accounting standards. But for presentation and disclosure requirements, you dip out of all the Australian accounting standards and you refer to a new standard called AASB 1060. And this is a standalone standard for Tier 2 entities, meaning all the disclosure requirements can be found in one place. And it's based on the International Financial Reporting Standard for Small and Medium-Sized Enterprises, or the IFRS for SMEs, with slight tweaks for the Australian context. So Tier 1 entities like our listeds listening today, no changes for you. You carry on applying full-blown IFRS as you have been. Entities currently preparing RDR, you will need to move to Tier 2 simplified disclosures. And those entities that will need to migrate from special purpose to general purpose financial statements, you will be able to choose Tier 1 or Tier 2. However, Tier 2 would probably be the way to go. Generally, entities that have the choice don't opt for Tier 1 if they don't have to. All right, so entities that currently prepare RDR accounts, let's start with you. As I've said, RDR will no longer be maintained from 1 July 2021, so from today. So you will have to migrate to the new Tier 2 simplified disclosures. What does this mean for you? Firstly, your numbers won't change because the recognition and measurement requirements are unchanged. Disclosures will, however, look a little different. AASB 1060, this new disclosure standard, sets out the minimum level of disclosures that Tier 2 entities will need to make. So technically, you can continue with your existing RDR disclosures because they are more onerous than simplified disclosures. And then you can just add in the extra few new disclosures required by simplified disclosures. Alternatively, you can adopt the new AASB 1060, which is, as I've said, a one-stop shop for all disclosures. No more flicking through all the accounting standards looking for the shaded bits as you had to do under RDR. Personally, I don't recommend continuing with RDR as a long-term solution. And that's because changes at the international level will not be reflected in RDR going forward because it's not being maintained anymore. AASB 1060, on the other hand, will be updated for changes to the international IFRS for SMEs. So it would be easier for you to stay on top of any changes that are relevant to you and your entity. Of course, the basis of preparation note in the financial statements would no longer be able to refer to reduced disclosure requirements. That would need to now reflect Australian Accounting Standards Simplified Disclosures. Take note, if you early adopt AASB 1060, in other words, in your 30 June 2021 or 31 December 2021 financial statements, you won't have to provide, or you don't, it's a choice, you don't have to provide comparative information in any new notes required by simplified disclosures. Well, considering the only new notes relate to audit fees and imputation credits, this relief is not that big a deal, so you may choose to only adopt simplified disclosures next year when it becomes mandatory. Although, having said that, having to prepare and audit fewer note disclosures this year might be enough incentive for you if you are an RDR preparer to adopt 1 year earlier than you have to. Let's now talk about those for-profit entities that currently prepare special purpose financial statements that will be impacted. Now, the standard that contains the rules relating to the removal of special purpose financial statements is AASB 2020-2. I've popped it on the slide there. It's quite a mouthful. You can see from the name makes it clear that it is only applicable to for-profit private sector entities. So again, if you are not in this space, you will not be impacted by what I'm about to talk about. The relevant mandatory date is 1 July 2021, meaning the changes will be effective for the first time in annual reporting periods beginning on or after today. So 30 June 2022 is your drop dead date if you are a June reporter, or 31 December 2022 if you're a December reporter. But I'm going to talk about this in a few slides' time. If you are a for-profit private sector entity, you have to consider 2 criteria. And if you meet either one of these criteria, you will be required to prepare general purpose financial statements going forward. The first criterion on the left is around legislation. If your entity is subject to a piece of legislation that requires the preparation of financial statements in accordance with Australian accounting standards or accounting standards, that's very deliberate, you will be captured and you will have to prepare general purpose financial statements from 1 July 2021. So, of course, entities preparing financial statements under the Corporations Act, you will be captured. So those would be your large private companies, including grandfathered companies, unlisted public companies, AFS licensees, small companies with crowdsourced funding, etc. The second criterion, moving over to the right, is it relates to a non-legislative requirement. So here it's about a constituting document or another document that requires compliance with Australian accounting standards. Again, deliberate, specifically Australian accounting standards only, not just accounting standards. What do I mean by constituting document? That's something like a trust deed, a partnership agreement, a joint venture agreement, any internal document that the entity operates under. Other document would be something like a loan agreement. And where such a document requires the preparation of financial statements in accordance with Australian accounting standards, general purpose financial statements could be required depending on the date that that document was created or amended. So let's look at this in a bit more detail. So if your entity is subject to, for example, a trust deed, or a loan agreement, I'm probably going to refer to trust deed the most because it's just easier to say. You would need to read that trust deed or that document and understand if there's a requirement in there to prepare financial statements in accordance with Australian accounting standards. If not, happy days. You can continue preparing special purpose financial statements. If there is a requirement for financial statements prepared under Australian accounting standards, the next thing you'd need to check is the date that the document was created and when and what changes have been made since. So starting on the left side, if the document was created before today, so before 1 July 2021, and it has not changed in any way since 1 July 2021, you get to grandfather your reporting requirements, meaning that you can continue preparing special purpose financial statements. You will have to make a few extra disclosures going forward about why you're preparing special purpose accounts, how you treat subsidiaries and investments in associates and joint ventures, and the extent to which the entity is complying with the recognition and measurement requirements of the accounting standards. The standard that will mandate these new extra disclosures for for-profit entities preparing special purpose accounts after 1 July 2021 hasn't yet been issued. It's been imminent for about 5 months out now, so I'm not sure what's going on, but I expect it will need to be issued very soon. Moving over to the right of the decision tree, where the document does require compliance with Australian accounting standards, and it was created on or after 1 July 2021, or it was changed in some way after 1 July 2021, but that reference to Australian accounting standards was left in, then the entity will have to prepare general purpose financial statements going forward. And the reference to Australian accounting standards is very specific. So if the requirement in the trust deed, for example, is for financial statements that comply with generally accepted accounting principles or accounting standards in baby letters, and these phrases are not explicitly defined elsewhere in the document, you will not be captured. I think the key thing here is if trustees and the like want flexibility around the type of financial statements the entity needs to prepare, they should use wording like financial statements prepared in accordance with the directions of the trustees in constituting and other documents. That will give you flexibility. You will not be locked into general purpose financial statements. Okay. So I've mentioned quite a few times that all these changes kick in from today, 1 July 2021. Entities preparing general purpose financial statements for the first time, or entities moving from RDR to simplified disclosures, have to do so for annual reporting periods beginning on or after today. So there on the slide, you can see what your drop dead date would be depending on your year end. If you early adopt, that date moves 1 year earlier. So for June reporters planning to early adopt the changes, you would be preparing your first set of general purpose accounts for the year ended 30 June 2021. And it may be really worthwhile early adopting due to the extra transitional relief that is offered as an incentive to entities to prepare general purpose financial statements earlier than they have to. Early adopters don't have to restate. So in the year of transition, early adopters do not have to restate comparatives. Also, in the year of transition, you don't have to put comparative information in any new notes required by simplified disclosures that weren't previously required, which for an entity that has always provided minimal notes in their special purpose accounts, this could be quite a cost and time saving. Just to emphasize, entities that do not early adopt, they don't have access to the relief from restating and presenting comparative information. Okay. How will entities that need to move from special purpose to general purpose financial statements do this? Well, the first thing they'll need to do is prepare an opening balance sheet on date of transition. Date of transition will be the first day of the current reporting period if you early adopt, or it will be the first day of the comparative period where you adopt in the mandatory year. I'm going to show you on the next slide what this will look like. The opening balance sheet will need to be prepared applying all the recognition and measurement requirements of Australian accounting standards, including consolidation and equity accounting. So for those entities not currently applying all the R&M rules of Australian accounting standards, including consolidating and equity accounting, then numerical adjustments would be needed to fix the numbers on date of transition. And those adjustments would go to retained earnings on date of transition. So let's have a look what this looks like. Oh, sorry, not yet. Next slide. All right. Entities currently not applying all the recognition and measurement rules of the accounting standards, including consolidation and equity accounting, will need to prepare the opening balance sheet using either AASB 1 or AASB 108. So I'll talk about AASB 108 first, because this is probably the standard or the approach that most of you are more familiar with. Using AASB 108 is the normal approach to transition. Essentially, it requires full-blown restatement whereby comparative numbers previously reported are restated as if all the recognition and measurement requirements of the accounting standards, including consolidation and equity accounting, have been correctly applied from day dot. So if a subsidiary was acquired 5 years ago and has never been consolidated, under this approach, you'd have to go back in time to acquisition date. You'd have to account for the acquisition of that subsidiary using the version of AASB 3 as it was then. You then have to consolidate from date of acquisition, fix up all subsequent numbers, consolidate all the numbers subsequent to acquisition date using the version of AASB 10. In other words, you'd have to take into account all changes to AASB 10 over subsequent years. So there's a lot of work involved in this approach and a lot of historic data needed to execute it. In terms of disclosures, in the year of transition, there are specific disclosures required by AASB 1060 under this approach, and I've just put it there on the slide should you need to refer to them. AASB 1 is the other option to use when transitioning to general purpose financial statements for the first time. This is a standard probably only a few of us are familiar with because we haven't had to use it before. Really, the last time most Australian entities would have had to use AASB 1 was back in 2005 when Australia adopted IFRS for the first time. Anyway, AASB 1 is similar to AASB 108 in that it also requires retrospective restatement, but the starting point is not day one or day dot. It's really the first day of the comparative period because of a number of exceptions and exemptions that entities can use to make transition to general purpose financial statements easier. Once again, there are specific disclosures that need to be made in the year of transition, and those can be found at paragraphs 206 to 213 in AASB 1060. That's the slide I was looking for. So this is a snapshot of what early adoption will look like in the financial statements for the year ended 30 June 2021, where AASB 1 and the additional relief from restating comparatives are used. The comparative numbers. So the numbers as at 30 June 2020 will be those special purpose financial statement numbers that were reported and audited in the last set of special purpose accounts. Importantly, they need to be clearly labeled as not complying with Australian accounting standards. The starting point or date of transition for general purpose financial statements that comply with all the recognition and measurement rules will be 1 July 2020, which is the first day of the current reporting period, not the first day of the comparative reporting period, because in this instance, comparatives don't need to be restated. 1 July 2020, being the date of transition, is the date you put through any transitional adjustments to fix up the numbers. And on date of transition, an equity reconciliation and an explanation of the changes needed to move from special purpose to general purpose financial statements must also be disclosed. The numbers as at 30 June 2021 will be compliant with Australian accounting standards. And just to reiterate, entities that early adopt, they don't have to restate comparatives, but they also don't have to provide comparative information in any new notes required by simplified disclosures. So where entities have not been applying all the recognition and measurement requirements in the past, and or their special purpose financial statement disclosures are minimal, there's quite a bit of incentive for them to transition to general purpose financial statements 1 year earlier. Probably also worth mentioning is that whether entities early adopt or not, they do not have to distinguish in the year of transition. They do not have to distinguish between prior period errors and adjustments arising on transition to general purpose financial statements as a result of changes in accounting policies. So you might realize, oops, while you're going through this process, you realize you haven't been applying AASB 9 correctly, even though you thought you were. That doesn't have to be fleshed out in your financial statements in the year of transition. In your equity reconciliation, you would just have balances as previously stated. You'd have a one-liner called something like adjustments arising on transition to general purpose financial statements, and that would include prior period errors because of incorrect application of R&M requirements, as well as changes to accounting policies. They can just all be lumped together. Where entities do not early adopt, so they prepare their general purpose financial statements for the year ended 30 June 2022, the date of transition is also 1 July 2020, but now this is the first day of the comparative period, not the first day of the current reporting period. Comparative information is restated because if you don't early adopt, you don't get access, you don't get that additional transitional relief. And that's restated either using AASB 108 or AASB 1, which is easier because of those mandatory exceptions and voluntary exemptions that effectively permit an alternative starting point. So from a comparability point of view, yes, this might look better, but it could mean a lot of work for entities depending on what their special purpose financial statements look like now. And that is special purpose in a nutshell. Marcus, I'll just pause at this point just to take a sip of my water. Are there any questions that have come through?
Michelle, I think the content must have been very comprehensive. So there's no questions at this point in relation to what we've covered so far, but if people do think of something as we go throughout the rest of the presentation, just please put it in the Q&A and we'll come towards that at the end of Michelle's presentation. No problem.
Good. Thank you, Marcus. All right. Well, that's special purpose. We will then carry on. All right. Unbelievably, the June reporting season is here, so it's always a good idea to know what's on ASIC's radar. So this is what ASIC will focus on in their financial statement reviews and their audit file inspections. And if directors and auditors get these wrong, it could lead to public naming and shaming for the company or the audit firm concerned. Now, the areas ASIC will be paying attention to for 30 June 2021, they're not surprising. They are unchanged from the focus areas for June and December last year. So asset values, provisions, solvency and going concern assessments, which could still be a challenge for entities in the current environment. Also post-balance sheet events, and then disclosures in the financial report and disclosures in the operating and financial review. ASIC, I would say ASIC is definitely paying close attention to what directors are saying or are not saying in the OFR. So directors should take care to ensure that the OFR complements the rest of the financial report. If there is one theme I can pick out, it's impairment, which ties into asset values. This continues to be top of ASIC's findings list, which shows that directors and auditors alike, they continue to struggle in this area. In fact, 10 of the 22 matters raised by ASIC in its latest round of financial report reviews related to impairment. So some of ASIC's impairment concerns are that cash flow forecasts and assumptions that underlie the impairment models don't stack up against things like historical data, economic and market conditions, or in fact, they haven't been updated to reflect the impact of the pandemic. ASIC also finds that entities are identifying cash generating units at too high a level, which runs the risk that impairment losses that should be recognized at a lower level aren't recognized. Something else ASIC is checking is that impairment models have been adjusted to reflect the change in the way that lessees account for leases under AASB 16, the new leases standard. So the carrying amounts of CGUs tested for impairment need to include any right of use assets recognized on the balance sheet. And at the same time, the cash flows in the impairment model should be adjusted to exclude those lease payments that have been taken into account in recognizing the lease liability on the balance sheet. Theoretically, you should get to the same number you got to before AASB 16, but it is very complicated and it's a complex area. And valuation experts are not shy to say that AASB 16 has absolutely wreaked havoc on valuation models. So just something to be aware of and probably worth dealing with early in the audit process to make sure that impairment models are appropriately adjusted for AASB 16. Lastly, ASIC feels that disclosures around impairment need to be improved to ensure that users understand the assumptions and the inputs that support the carrying value of certain assets, and so that they can make their own independent assessment about the risk of impairment. ASIC reviews often give rise to ASIC restatements. So I flagged the two that have been announced since January this year, all of which relate in some way, shape or form to impairment of assets. You can see there, goodwill, deferred tax assets, certain non-financial assets, expected credit losses, which is linked to the recoverability of debtors and inventories. So probably also just a further reminder that directors should continue focusing on impairments. For the June reporters that have tuned in today, I'm sure you're aware, but I thought I'd just remind you that ASIC has granted you an additional month to lodge your financial statements. The 1 month extension applies to listed and unlisted entities reporting under Chapter 2M of the Corps Act, with a balance date from 23 June 2021 up until 7 July 2021. And the table on the slide there just summarizes the new deadline per type of entity that reports under the Corps Act, under Chapter 2M. For listed entities, there is no change to the reporting deadline for your preliminary final reports, but these can be unaudited if audited information is not yet available. And then also, if you are a listed entity, just a reminder you need to inform the market where you rely on the ASIC lodgement extension, and you are encouraged to disclose your reasons for doing so. With respect to annual general meetings, public companies have an additional, with year ends up to 7 July 2021, you have an extra 2 months to hold your AGM without ASIC taking any action against the company. I'm not sure if there are any AFS licensees listening in today, but if there are, you also have an additional month to lodge your profit and loss statement and your balance sheet. And this, I've just summarized it there on the slide for you. All right, let's move away from ASIC. Let's turn our minds to the new accounting standards for 30 June 2021. And as I've already alluded to, very exciting that there's not too much happening on this front. All of the pronouncements there on the slide, apart from the last one, are effective for annual periods beginning on or after 1 January 2020. So our December reporters, you would already be applying these if they were relevant to you. And our June reporters, you will be applying these if relevant if for the first time in your 30 June 2021 financial statements. Just two worth chatting about, starting with the refined definition of a business. This amendment will be important for you if you've made any acquisitions since 1 January 2020. Distinguishing between an asset acquisition and the acquisition of a business is important because the accounting for the two is very different. So for example, a business combination may give rise to goodwill, while an asset acquisition never does. At a high level, the amendments to the business combination standard, AASB 3, are aimed at making this distinction easier. So the standard makes it clear now that to be considered a business, you don't need all the inputs and all the processes needed to generate outputs, as long as you have, at a minimum, an input and a substantive process that together significantly contribute to the ability to create outputs. And there's heaps of guidance as well as illustrative examples that have been added to AASB 3 to help entities assess whether a process that's been acquired is in fact substantive. The changes also introduce what they call an optional fair value concentration test, which is a shortcut way of concluding that an asset acquisition is not a business combination. So simplistically, if an entity buys another entity that has a property, a few other bits and bobs on the balance sheet, and a few employees, if the fair value of the property, as determined under AASB 13, is 9 million, and the acquirer pays 10 million for the entity, the concentration test will be passed because substantially all of the fair value of the gross assets acquired is concentrated in a single identifiable asset, being the property. So no further analysis is needed under AASB 3, and it can be concluded that the transaction is an asset acquisition and you would account for it as such. So either using AASB 116 or AASB 140, whichever is the relevant standard. There are very specific rules that need to be applied when you use the optional fair value concentration test, but there's a really good example in the standard that shows how these rules should be applied. For those entities that have received rent concessions because of the pandemic, this amendment is for you. If you recall, last year, the leases standard was amended to provide practical relief to lessees who are given COVID-19 rent concessions by their landlords. So without this relief, lessees would be required to apply lease modification accounting, which we're going to talk about shortly, which involves remeasuring the lease liability using an updated discount rate and then adjusting either the right of use asset and or profit or loss depending on the type of concession granted. Using the optional relief, lessees don't have to assess if eligible rent concessions are lease modifications. They can just treat those rent concessions as variable lease payments through profit and loss. To be eligible for the simplified accounting, however, the rent concessions must meet all three criteria there on the slide. This particular amendment, AASB 2021-3, extends the scope of the original relief by 12 months. So rent concessions that reduce the lease payments originally due on or before 30 June 2022 was 2021 will now qualify to be treated as variable lease payments as long as they meet the other two criteria. I included this in the slide deck. This example never made it into the final amendment to AASB 16, but it is so helpful because it very nicely shows how to account for rent concessions applying the practical expedients that I've just talked about. So please refer to this if you need to see what the accounting looks like for the forgiveness of rent, the deferral of rent payments, or perhaps a combination of both. And worthwhile just reminding everyone, I called these the old new standards, AASB 9, 15, 16, 1058. They've been around a while now, so hopefully we are all a bit more comfortable with them, but they still continue to pose challenges. They are very difficult standards to apply, particularly AASB 15. So worthwhile just making sure that we're applying these standards correctly in the 2021 year as well. No doubt ASIC will also be continuing to focus on these standards as they are difficult and they are still fairly new. Unfortunately, and that's the thing with these standards, they aren't set and forget standards, just like AASB 16. So I say AASB 16 is not a set and forget standard because over the life of a lease, there could be various ongoing changes, and the accounting differs depending on the type of change involved. Now, the change could either be a reassessment or a remeasurement, or it could be a modification, and the standard uses very explicit terminology to differentiate between the two. So starting on the left, reassessments or remeasurements occur when there's a change in estimates used in the initial lease accounting. So for example, a change in the original assessment of the lease term because of a change in the assessment of an extension, termination, or purchase option being exercised or not being exercised. Remeasurement would also be required when there is a change in the guaranteed residual value and when there are changes to future lease payments because of a change in the index or rate to which those payments are linked, like CPI. The thing to take note of here is that the discount rate remains unchanged when you remeasure the lease liability, except when the change relates to a change in the assessment of an extension, termination, or purchase option being exercised or not being exercised. In this case, you have to use a revised discount rate to remeasure the lease liability. So you remeasure the lease liability, the other side of the entry goes to the right of use asset, unless the right of use asset is already fully written down, in which case the difference would go to profit or loss. And remeasurements are always accounted for prospectively because essentially they are a change in accounting estimate. On the right side, a lease modification is different to a lease reassessment and it requires different accounting. A lease modification is a change in the scope of or the consideration for the lease that was not part of the original terms and conditions. The thing with modifications is that every time there is a modification, the discount rate has to be updated, which can be a real hassle if you have a large lease portfolio. Whether or not there is a P&L impact is going to depend on the type of modification, which I've tried to summarize for you on this slide. So as I've said, essentially, modifications are changes from renegotiations and changes to the terms of the original lease. These are accounted for on the effective date of the modification, which is the date that both the lessee and the lessor agree to the change. A key distinction in accounting for lease modifications is assessing whether they create a separate lease. Now, this usually happens when the modification adds a right of use asset at its standalone price. Let me give you an example. An entity currently leases 2,000 square meters of office space and subsequently adds another 3,000 square meters to the lease. If the increase in the consideration for the additional 3,000 square meters, sorry, I've just lost my train of thought. If the additional consideration for the additional space is market related, this is a separate lease. So what it means is that the additional 3,000 square meters will be treated as a new lease, and it will be capitalized using the principles, the normal principles under AASB 16. There is no change to the accounting for the initial lease of 2,000 square meters. Continuing with my office example, if the additional 3,000 square meters was leased at a discount, because of the space the entity was already leasing, this would not be a separate lease. This falls into the other modifications bucket, along with things like an increase in the lease term or a change in consideration. So for these modifications, the lease liability gets remeasured using an updated discount rate, and a corresponding adjustment is made to the right of use asset, so no impact to profit and loss. The third type of modification relates to a decrease in scope, which might be quite common in the current environment, certainly for Melbourne CBD office space. So examples would be shortening the contractual lease term or removing one or more underlying assets. The accounting for these changes is a bit more involved, and the remeasurement requires two steps. Firstly, you have to account for the partial termination of the lease, and this you do by reducing the carrying amount of the right of use asset by the relative amount. So example, 50% for office space that is halved. And then you remeasure the lease liability for the remaining lease payments using the original discount rate. Any difference between the reduction in the right of use assets and a reduction in the lease liability would go to profit or loss. The second step is then to remeasure the lease liability to reflect the updated discount rate, and any resulting adjustment because of this second step goes to the right of use asset. So that is lease modifications in a nutshell. And of course, don't forget the COVID-19 optional practical expedient, which I covered a few slides back. Just a quick reminder about lease term. I sometimes get asked about this, so I don't think people are always aware of the agenda decision that was issued by the IFRIC back in November 2019. Now, agenda decisions are important because they reflect how accounting standards should be applied in very specific scenarios. They are authoritative, so once they are issued, entities need to apply the guidance in the agenda decision within a reasonable time frame if their current accounting practices are not consistent with the guidance in the agenda decision. This particular agenda decision clarifies how the lease term should be determined for arrangements that automatically renew until one of the parties gives notice to terminate. Examples of this type of arrangement are on the slide there. So a lease with a non-cancelable period of 3 years with the option to extend for 2 years, after which it becomes a month-to-month lease. Or a lease with just a non-cancelable period, so say 3 years, after which either party can terminate with 6 months written notice. It also covers those situations where there is no specific non-cancelable period. So rather the lease continues until either party gives notice. For example, a lease that continues, the lease of an asset on a day-to-day basis, which is quite common between related parties. In all of these cases, either party has the right to terminate without incurring a financial penalty. So what is the lease term, if any, for these leases once the non-cancelable period and any optional periods are over? Now, AASB 16 says that the lease term depends on whether the lease is considered to be enforceable. And under AASB 16, a lease is no longer enforceable when both the lessee and the lessor have the right to terminate the lease without incurring a penalty that is more than insignificant. And what's important here, and what the agenda decision clarifies, is that the word penalty goes beyond contractually stipulated penalties. It encompasses all economic penalties that are more than insignificant. So for a lessee, that might include the existence of any significant leasehold improvements and the costs involved in transferring these to a different property or scrapping them. If finding a replacement asset is costly or difficult, how likely is the lessee to terminate the lease then? So what is the lease term? Ultimately, entities are going to have to exercise judgment in assessing the lease term in these situations. And I thought I'd include an example just to show you how judgmental an area this can be. So think of a lease of office space with a non-cancelable period of 3 years and an option to extend for another 2 years. Thereafter, it converts to a monthly tenancy where either party may terminate by giving 1 month's notice without incurring a financial penalty. So assume the lessee has installed highly specialized, costly office equipment that cannot be transferred to another property, and the useful life of this equipment is 15 years. What is the lease term? Is it 3 years, the non-cancelable period? Is it 5 years, the non-cancelable period plus the optional period? Is it 15 years, the useful life of the equipment? So in this case, based on the very limited information provided, I don't think a lease term of 3 years is appropriate because it is reasonably certain that the lessee will exercise its option to extend for another 2 years. However, the lessee is likely to incur an economic penalty if it terminates the lease at the end of 5 years, because it's going to have to replace the equipment, which would probably be very expensive to do. Applying the agenda decision, even though the lessor may not incur any economic penalty if the contract ends at the end of 5 years, the contract is considered to be enforceable beyond that date because the lessee suffers an economic penalty if it ends on that date. So it could be argued that the enforceable period in this case is 15 years, being the useful life of the equipment. Perhaps it is expected that more advanced equipment will be available in 10 years' time. In this case, based on the facts and circumstances, it could be argued then that the lessee will exercise its option to terminate the lease after 10 years. So really, it's a judgment call that needs to be made at commencement of the lease, very important, at the commencement. And the difference in the lease liability between a 3-year lease and a 15-year lease, you can imagine that would be quite substantial. Anyway, so as I've said, this assessment of lease term is made at the commencement of the lease. And if that assessment changes over the life of the lease liability and the right of use asset will need to be adjusted to reflect the change. All right, in terms of global accounting developments, there are 2 things I thought would be worthy bringing to your attention. Firstly, 2 more agenda decisions that were issued by the IFRS Interpretations Committee, or the IFRIC, relating to SaaS arrangements or cloud-based software arrangements, which is becoming quite mainstream. So in a nutshell, the first agenda decision issued in March 2019 concluded that where a customer pays a monthly fee for access to a supplier's software hosted in the cloud, this isn't a lease because the customer does not control the use of the cloud software. And it also doesn't give rise to an intangible asset, as ultimately the customer does not control the software, meaning it can't obtain the future benefits that flow from the software. So the monthly fee for this type of arrangement should be expensed for the period of the contract, as this is essentially a service contract. The second agenda decision is a bit more involved, but the crux of the matter is that if a customer incurs costs to configure or customize cloud-based software that it does not own, so similar to the arrangement in the first agenda decision, those costs, generally speaking, need to be expensed when the customer receives the configuration or customization services. Now, the agenda decision goes on to explain how you use the principles in AASB 15, the revenue standard, to assess when the services are received by the customer, because that will drive when the expense needs to be recognized. And it's all about whether the configuration or customization services are distinct or separately identifiable from the access to the cloud-based software. I have recently published an article that addresses both these agenda decisions in more detail. So please do refer to our latest financial reporting publication called The Bottom Line. I think it's issue 10, if you need more information on this subject. Oh, yes, and just worth mentioning that ASIC's latest focus areas, the announcements that about the latest focus, getting my tongue twisted. ASIC's latest focus areas specifically referenced this agenda decision issued back in April 2021. So best we pay attention to our intangible software, our software that has been recognized as intangible assets, and make sure that what we have capitalized it's appropriate to do so. And finally, I thought it's worth mentioning what's currently going on at the international level with respect to the classification of liabilities. So there have been some recent amendments to the accounting requirements that deal with the classification of liabilities as either current or non-current. While these amendments don't change any of the existing requirements, they were added to try and reduce the diversity in practice in applying them. So debt is still classified as non-current if the borrower has the right to defer settlement for at least 12 months after balance date. The problem is that paragraph 72A, which I've put on the slide there, was never exposed for public comment. It kind of just was snuck into the final amendments, and it's this paragraph that's causing some confusion, because it says if the right to defer settlement is subject to the entity complying with specified conditions, the right exists at the end of the reporting period only if the entity complies with those conditions at the end of the reporting period. The entity must comply with the conditions at the end of the reporting period, even if the lender does not test compliance until a later date. So the IFRIC, which is the committee that helps interpret the accounting standards and which issues agenda decisions, was asked, how do you apply this paragraph to a long-term liability that is subject to a condition that is tested subsequent to reporting dates? And the IFRIC came back and said that in its view, applying the amendments means that the borrower would have to perform a hypothetical test of compliance with future conditions based on the numbers at reporting date. And if the future condition is not met at reporting date, the debt would have to be classified as current. And this really just doesn't make sense, because very often covenants are tailored to suit the needs of entities, whether that's because of seasonality or because of the specific stage of life that a company is in. So using a hypothetical test to classify debt wouldn't necessarily reflect the purpose and economic substance of the covenants. And it also wouldn't reflect the contractual rights and obligations at reporting date of the parties involved. So needless to say, there has been huge pushback from stakeholders around the globe, and the matter is now being taken back to the international board. Luckily, these amendments don't kick in until 1 January 2023, so there is still some time to sort out this mess. But if you do have covenants that are tested at various points throughout the year, best you watch this space, as you might need to change the classification of your debt if the amendments remain as they currently are. And I think that is it. Yes, Marcus.
Thank you, Michelle. Great presentation, as always. Now, in terms of questions, we do have one question for you. So this is a general question on special purpose financial statements.
Yes.
Bit of a long question, but can you clarify what entities are required to comply with if they are still able to produce special purpose financial statements, i.e., do they need to apply any recognition and measurement standards? I always thought recognition and measurement is a minimum requirement, but that only disclosure elements of standards can be done away with.
Okay, so there's quite a few questions in there. So I make sure I understand. Those entities that can continue preparing special purpose financial statements, what R&M requirements do they need to comply with? Was that the question?
Yep. Do they need to apply any recognition and measurement standards if they can still do special purpose?
It's up to the directors. It's up to the directors to choose the appropriate accounting policies that suit the needs of that entity. So no, if you're preparing special purpose financial statements from 1 July 2021, I guess you can pick and choose what you do in those financial statements, but what is important is that the basis of preparation makes it very clear to the users what R&M is or is not being applied, and that they shouldn't hold themselves out to be complying with all the recognition and measurement requirements of Australian accounting standards if they aren't. So those entities, just to paraphrase, if you may continue preparing special purpose financial statements, you can pick and choose what you want to do, whatever suits your entity, but be clear about it in the basis of preparation note.
Great. Okay, thank you, Michelle. If people do have additional questions just as we finish up now with the webinar, do feel free to get in contact with your HB representative, and we'll be able to have a look at that for you. If we don't know the answer, we'll be able to go back to Michelle on that as well. So that concludes the webinar this morning. Once again, very special thank you to Michelle for her time this morning.
You're welcome.
Hopefully it won't be too long before we see you over in Perth in person, after some normality returns to the world, whenever that may be. Now at HB Mann Judd, obviously we endeavour to keep doing these sort of events for people and just keep you informed of the latest developments. So we trust you found the webinar useful. Thank you everybody for attending, and we'll hopefully see you all again soon. Thank you.
Bye everyone.